Market structure is by far the most powerful technical analysis concept that you can use if you want to become a profitable trader. And yet it's so easy to get it wrong. And honestly, that's why most traders fail. You see, as a trader, the most important thing that you need to understand is which direction is the market likely to trade. If you can get that right, you drastically minimize the chances of you losing trades and drastically maximize the chances of you winning trades. So in this video, I'm going to be sharing with you a full course breakdown on how you can finally master market structure to make sure that you're trading on the right side of the market consistently. So diving straight in, there are three phases in which the market is always trading through. On the one hand, we have the bullish expansion. This is where price is progressively getting higher, making a series of highs, higher highs, lows, and higher lows. A higher high is simply when a high breaks an old high. That is your direct indication that price action is bullish. Price is more likely to trade higher in the future than it is to trade lower. Already you have a statistical edge. And again, the same thing is when these lows are getting higher than the previous lows, right? That is, again, signs of bullish price action. Now, eventually what happens in every trend is it gets exhausted. And the first sign of a reversal is usually a consolidation. A consolidation is where we have a high and a low that is in control of the price action, right? That is your current market structure range. Now, what price does is it usually spends a decent portion of time just kind of moving sideways below the high, but above the low. So not really giving us any clear direction. Is price going to continue trading higher? Is price going to trade lower? That sideways consolidation is usually the first sign of the next leg up, or in many cases, a bearish correction. Then usually we have what follows is bearish expansion. And the bearish expansion can be categorized by understanding when the bullish structure has shifted. It is not, which many people make the mistake of, when these lows in here start trading lower. It is when this low right here that is responsible for breaking the previous high and putting in this high right here gets broken and traded through. That is what we call a change of character. The shift from bullish to bearish, right? Think of the bull is in control and then the bear becomes in control. Those are the two characters. We change character, right? And then we begin with the bearish expansion. So we put in a lower low. This low right here is lower than the previous low, indicating bearish price action. Then we have a lower high. This high is lower than the previous high. And then we get the continuation, break of structure, lower low, lower high, and lower low. From here, what you're expecting then is very simple. And your only job as a trader is to understand that price is now bearish. Therefore, how can I look at shorting, right? And those are the things that we'll get into later in the video. But what you're essentially expecting is when price retraces back up to these highs, I want to find an opportunity to get involved in short positions, and then I can take the market down here. And so that is, in essence, the three phases of price action that we will continuously see play out. Now, if we come here to the actual live market, you'll see this unfold in real time. What you can see here on euro-dollar 30-minute time frame is that we have bullish price action. So we have a swing low down here. That price puts in a high up in here. This high puts in a low down here. Right? Notice that this low is higher than the previous low. Then we have a break of structure with a higher high, right? So now we have highs getting higher, lows getting higher. Then you can see we have this pullback before a continuation. We continue trading in this bullish direction. Then we have a pullback. Again, what do you think is your job at this point in time? We have this low, we have this high. Our structural range is this high to this low. You're looking to long the market. And so when price starts coming its way back down here, the goal is to get involved in this bullish move and take out this old high. Once this happens, you have a new low, right? And then a new high. Now look what happens. We've had a very aggressively long bullish trend. And then eventually what happens is we put in a high right here, right? And we have our low down here. So that is our current structural range. Now, what happens is price starts to move sideways, right? We don't really get a real break of a high, a real break of a low. In fact, what you see here is that we get this wick, right? And for me, a wick is not a break of structure. That is what we refer to as a liquidation. You see, every time that you have a low and every time you have a high, when price approaches this level and it wicks above that level, you can likely expect that price will then reject that area and trade in the opposite direction. And the reason for that is purely based off of the order flow. Price gets above this high, and then the thing is no one is willing to now buy more orders above this high. And so that's why we have the wick, right? And price closes back down here. And that essentially tells you, with just that wick, that price is not willing to trade higher. And because of that, you can already indicate weaker price action. So if I know that a wick is a sign of weakness as it expands out of a range, then why would I want to buy out of that range? It's going to likely go in the opposite direction. The same is true on the sell side, right? You can see we get the wick and then we have a reversal, right? If we then look at the low down here, ultimately what happens? We fail to break through this low. We wick the low. That to me is a sign of weakness, right? It's a sign of reversal. And then you can see we end up reversing and we come back up here. So we can see here, we're getting wicks of the high and wick of the low, which is really just indecisive price action. This is a consolidation phase. And the likelihood is, in many cases, when we get this type of consolidation, is that a reversal is most likely coming because price is unable to keep trading higher. The reality is if market structure is continuing to go bullish, there would be no problem trading through this high and continuing, like we have done many times in the past. We trade above, we continue, we trade above, we continue. Here, we try to trade above and we get a rejection. That simply tells us that the likelihood is that we're gonna reverse. Again, if you look at this liquidity concept, you can see all the time when you have a higher or low that gets liquidated, right? Here we have a low. Look what happens. Price comes into that low, it wicks below that low and reverses. Price comes into the high, it wicks that high and then it reverses, even down to the minute micro details, right? We have a high here. Price comes up to this high, wicks up that high and then reverses. So always pay attention to when price is wicking a low or wicking a high and look at that as a sign of reversal. Only when we can close below this low down here can I then say, great, now we have shifted. We are no longer bullish, we are bearish, expecting lower prices. And we can see how that unfolds, right? We become bearish, price trades aggressively to the sell side until we find a low, we have a retracement, we find a high, we have a continuation, we find a low, we come back up, we find a high, and then we continue trading down here, low, high, and then this brings us to right now's current day price action. I would expect that today's most likely going to trade lower. It already gives me my indication. That is the importance of market structure, right? It's going to tell you the directional bias. But here's the catch. Now I've made that sound simple and look simple because in all honesty, it is. But there are a couple of things that are messing people up, and this is one of them. It's this idea that there is a real market structure, and it looks like this, and it confuses the crap out of people. What we have is a high, we have a low, which is what you've been taught, we have a higher high, amazing, very easy to understand, right? It's what you've been taught. But then it starts getting complicated because you start having pullbacks that look like this. And now what a lot of people do is they look at this and they're like, okay, we have a low, we have, okay, this high is lower than the previous high. Okay, we have a lower low down here, a lower high. Okay, we're obviously bearish. So let's sell the market. And so what do? They start selling the market down here, not realizing that they're looking at the wrong structural points. It's a critical mistake that traders are making when it comes to market structure, is they don't understand which structure, which highs, which lows to use. And that's what I'm going to break down to you now. You see, this is the low that breaks through the high. This is the high that begins the reversal. So that's all you need to have. You have your swing low and you have your swing high. We've broke structure, so we are bullish. Now, until price breaks below this low, we do not shift bearish. We only look for longs. The problem is many traders are thinking that price is bearish because of these lows, but they're reading the wrong market structure. They are reading internal structure. You need to be focused on these swing points in here. You can only get the green flag to go long and continue when you get, okay, we're bearish internal, great. Now we're bullish internal. Now it's the time to look for longs. And then you can see price break structure. So now we break structure here toward the buy side. Now here's the other kicker. This is now our swing low. This up here is our swing high. And so we're expecting longs. We're expecting that price will respect this low and it will target this high. Again, here's another fatal mistake that traders make, is they look at this and they're like, okay, we have a low. Okay, we have a higher high. Great. Bullish. Okay, higher low, higher high. Okay, so here's my low, here's my high. Oh, look, we break through this low. Okay, now I'm going to look for sells because we're bearish. Wrong. Until we break this low, it is the low the lowest point that structure comes before breaking structure again. It's this low right here. Many traders are getting trapped on the wrong side of the market. That's why there's so many failing traders, because they don't understand how to read market structure. You have to use this low and this high. So when this low gets taken out, that for me is like, great, that's an inducement, right? Because so many traders are now going to be looking to go the other side. But for me, I'm still very much bullish. And so when I get this shift above here, that's my green light. And then I patiently wait for price to come back in. And then where do you think that price is likely to go to next? The next logical target is for price to run toward this high. That is real market structure. It looks confusing, but it's very simple. It's not really much different to what we just covered in here. We have these pullbacks. It's just that inside of these pullbacks, there are little pullbacks that get you confused. Let's go and take a look at what this looks like in the actual market. So imagine for a second that we have a low down here, we have a high here, a low here, higher high. So we're bullish, right? Let's just say we're bullish. Now, here's the thing that throws people off. For me, it goes like this. Low here, here's what people think. People use this high, and then this low, and then this high. And then when price puts in this low down here, they're like, okay, great, we've shifted bearish. Let me look at shorting. It's like, no, it's not this here. It has to have at least 3 candles that pull back. So it's high, low, higher high, higher low, right? Again, same thing. People will look at this, they're like, okay, oh, low. Oh, high. Oh, new low. Okay, bearish. It's like, no, this is the low. This is the high. If it's above this low, it's bullish. Don't use anything else. Everything else is internal. It's like all these traders are looking at these structural points, trying to use these. And it's like, no, none of that is structure. It's just noise for you to get distracted in. If it's above this low, it's bullish. Until it breaks above this high, this is the low in control. And then for me, it's higher high. But again, many people are looking at this like oh, new high, oh, new low, oh, new high. It's like, no. It's like when we break this high, this is the low. So now the structure is like this, from this low to this high. And then we break structure. You can see that we're respecting our structural levels. Then what happens? Price comes back, we put in a low, we go again, we find a high. And then we have high to low. And price cannot break out of this level. We wick, that doesn't count. We wick, that doesn't count. When we break and close, that's good. So now we go to bearish. And so again, my structure becomes low, high, low, high, low, high, low, possible high. We don't know until it breaks it. What do many other traders look at? Many other traders are looking at it like this. Okay, low, high, low, high, low, high. It's like, you're just going to confuse yourself. That's exactly why you get stuck. Because you're using all of these rubbish terms for market structure. No, none of that is market structure. This is market structure. It's the external swing points. Forget the internal. The most important part of trading is being on the right side of the market. And yet you're getting caught on the wrong side of the market because you're not doing this. You're using all of these internal structural points. Just don't do it. The next super important point that I need to make is that you have to combine structure with supply and demand. Market structure alone won't work. Fibonacci's, it's not going to work. You need to use supply and demand. So what is supply and demand, and how do you combine it with structure? So you can see here that we have a low, a high, we make a new low, and then we make a new high. Now notice in here, we have this area of price where price has a lot of volume before an aggressive move. Price comes back up, we have another aggressive move. We want to look at these areas of demand. Right? What is demand? Demand is, a group of people or one institution flocking to buy a lot of something at one price. Therefore, it moves higher. Simple supply and demand in economics. If there is more demand than there is supply for that thing, the price will increase. So just look at where you have sharp, aggressive price increases. There you will find demand. And so what you want to be looking at is when you have these large impulsive legs, look at the volume that took place just before that impulsive move. There you will find your demand. The same can be true for supply. If you look at supply, you just want to find the areas of price that we were trading at before we have the aggressive move, and there you will find supply. And you'll see interactions with that. And then demand comes in, right? So what you need to do is when you see market structure, you need to then identify areas of supply and demand. And now I'll show you what that actually looks like. So if we come back into this same price action and we apply the same principles, here's what we will find. Remember, we have our market structure as high, low, low, right? To high, to low, to high, low, high, low, high. Now you need to apply supply and demand. So for example, here we have a bullish move in here. Now, where's the bulk of the volume before that happens? It's in here. So there's your demand. You want to wait for price to come back into the demand before you can long. Here we don't have price come back into the demand. Okay, fine. Then we see price pull back and then aggressive run up. Where's the bulk of the volume happen before that happens? It's in here, right? This is the area where we have the transactions and then price aggressively moves. So there's your demand. So after you get the run of that high, you wait for price to come back to your demand. Here's a critical mistake that a lot of traders make as well, is when they're trading market structure, they think, okay, cool, let's say that's my high, then I should just buy when price breaks above it. So they buy here, and maybe they put the stop loss below here. The problem with this is like, number one, your risk to reward is low. And number two is like, where do you target? You don't have an area of price where you now expect that price should trade towards. You don't, you're just guessing. And so maybe you're going for, let's say, a 1 to 3 risk reward, and price comes back up here, and now all of a sudden you move your stop loss to break even, and price comes takes you out of break even. And then it goes in your direction, right? Or maybe you go for a 1 to 1, and great, you make it, but how many of those trades are you gonna make? So the problem with those traders is they're buying too early. You don't wanna be the first one to the party. It's like a game of poker. With trading, you have the ability to wait for the market to show you its hand. Then you can bet chips. That is the game of trading. You see, trading is very similar in nature to gambling, but there are gamblers out there, professional poker players, who make millions and millions of dollars because they understand probabilities and they understand psychology. Well, the market is not too different. It's probabilities and psychology. The bonus with trading is you can wait for the market to show you its hand, right? Sometimes it may bluff you, but a lot of the times it will show you what it's going to do before it does it, and then you can decide whether or not you're going to take that bet. I mean, imagine for a second, you were playing a game of poker, me and you right now, and let's say I bet $1,000, and before you decide whether you want to match that bet, you get to see what cards I have and what is on the table. And then you can decide, well, either I have a better hand than him, or he has a better hand than me. If you have a better hand, you can bet your money. If you don't have a better hand, be like, no, fold. The market gives you the chance to do that. So that's what supply and demand and market structure combination is all about. It's you wait for the move, and then you wait for price to come back into this area, so then you can catch the long move in here. You don't have to enter the market early. And sometimes that may mean that you miss out on opportunities because price goes and it doesn't come back. That's fine. That's part of the game of trading. It's about an edge. So same thing happens again, right? Now we have multiple areas where price increases. We have aggressive move in here, we have consolidation, aggressive move, consolidation, aggressive move. So we have phase one of demand, really and truly is this entire level in here, right? From the sell down here to the buy. What happens? We have aggressive move out, we come back into the demand, and then we trade away. Then we have a new demand, and that new demand is pretty much this range here, right? This is the next level where we get consolidation, and then large moves to the upside. That's demand. Price goes up, we consolidate, and then we go aggressively again to the upside. That's demand. Now notice that price doesn't come back and tag us in here before it goes. That's fine. You're not going to get that every single time. Then what we have is the next phase. We have aggressive demand. So what we have here is we have consolidation, a small aggressive move, which is demand in here, and then price comes into that demand, and then we have aggressive move again. Now the demand is where? From this area here to here. You could also, in this instance, use this entire leg of price, right? This is the consolidation, and then you have the aggressive demand. And so it's like, okay, you just wait for price to get back into that area where price moved from, because this is the area where the buyer steps into the market and the market became imbalanced. Market seeks equilibrium, right? Comes back into balance, and then we get the next leg up, probabilities of market structure. And that is essentially how you combine supply and demand. So it's very simple. The final principle that I want to share to you before we put this all together is confirmations. You see, it's one thing having market structure. It's important, it's great. Alone, it's not going to help you. Then you add supply and demand, and now it becomes even more powerful. But alone, it doesn't help you. Imagine you have market structure with supply and demand plus confirmations. Now you have a cheat code. So what is confirmations and how does it look? Well, same thing applies, right? We have a low here, a high, we have a new low and a new higher high. So the market is bullish. We have a break of structure above the highs in here. Break of structure, great, we are bullish. We are looking for longs. Second thing that we do is we find our area of demand. So here we have a very aggressive and bullish move up. But just before that happens, we have an area of consolidation where we may see institutions or certain individuals loading up on their positions, where the demand really kicks in, right? So this is our area of demand. Now here's the catch, right? Let's say that this in dark here is the 15-minute time frame. And let's say in the dotted line here, it's the 1-minute time frame. What's going to happen is when you have price action like this in the 15-minute, when the 1-minute comes back here, it's going to be bearish and it's going to look like this, right? So on the 1-minute time frame, as price approaches your area of demand, you simply apply patience. When we get in here, you can see that we're bearish, right? Lower low, lower high, lower low, lower high, lower low, consolidation, lower high, lower low. Inside of our demand, you simply wait for this confirmation. When this high gets broken in here, now you have literally a cheat code, because this is really what my model is, right? This is honestly one of my most powerful trader models. Now you have confirmation on top of everything. So we already know that probability indicates that we are going to trade into this high. We already know we're bullish. We already know that we're trading from an area of demand. Now we've confirmed that we're going to trade higher because price is trading higher. We've confirmed that this demand area is valid because we're seeing demand come back in from that same level. Now all you have to do is trade. And so again, a big thing that traders do wrong is they try to trade like this. 15-minute time frame, bullish, find the demand area and trade like that. Right? 1 to 2 risk reward. Or maybe sometimes what you'll find is that you have multiple areas of demand in the same price leg. Now what do you do? When you wait for the lower time frame, you have something different. Because now what I can do is I can use this same structure and I can use this same, let's say, area of demand on the 1-minute time frame or the 5-minute time frame. And I can take this trade, the same trade idea, but different entry after confirmation. So now what I have, by adding this confirmation principle, which so few people do, I am increasing my risk to reward from 1 to 2 to 1 to 5, and I'm further confirming the likelihood that I win this trade. So I've increased the likelihood that I'll win, and I've increased how much I'm going to win just by adding this one principle. And that is essentially it. And then you patiently wait for price to come back in and then take you away to your direction, which is already mostly confirmed. So now I want to show you everything combined by breaking down this one simple trade, combining everything that we just learned. Before we break down the trade, we have to understand how did we get here, right? How do we know that price is going to trade lower? To understand that, we have to understand what has happened before we're here. So if we go back and look at the 15-minute time frame, right? For me, it's very easy to see that we were bullish, right? And then we shifted bearish. But if we go deeper, we can break it down clearer, right? We were bullish in here, quite obviously. Eventually, at some point, we put in this high. This high produced this low, and this low produced this high. So that's a break of structure. So that was our final break of structure towards the buy side. Then we had a change of character. So we became bearish, right? We respected the high, and then we traded lower. We continued bearish, break of structure. Then what happened? This was our high. We respect it multiple times. This was our low. We continue trading bearish. So we have high, low. Then what happens? Price comes back up to here, respects the high. Eventually, it takes out the low, and then we have a lower low. Now, before this trade is executed during my London session, we'll come back to before London session even begins. So this is the picture that I have when I'm coming into the live market. I see that my directional bias is bearish. We're bearish. My swing high is here. My swing low is down here. So I know that we're bearish. Now, if you look closely, what happens? We have aggressive move. We have a pullback. We have consolidation. And then we have aggressive sells. Aggressive sells. Notice that this area here, before we have this aggressive sell-off, that's the consolidation. That is probably my supply area. So I understand that in this area in here, right, we have a bunch of supply. So this is my area. So I simply just wait for price to return to this level. And then when I get there on the 1-minute time frame, I wait for the 1 minute to shift bearish. Because on the way up, by the time we get there, right, we're here now. If we look at the 1-minute time frame, look at what we see. The 1-minute time frame is quite obviously bullish, right? We have all of this dodgy price action, but then we eventually become clear and we have high, low, high, low, high. So the 1 minute is bullish. All we do is wait. We don't want to try to sell when the 1 minute current price action is bullish. We wait for confirmation. So I'm simply just waiting until eventually we're waiting for this low right here to get broken. The moment that this low gets broken, again, not with a wick, with a break, that is my confirmation that now price has shifted bearish, right? So that's my change of character. So then it's about understanding, well, where's the supply? Where did the supply come out? Well, you can see that we had a run up, a run down, consolidation, supply, trade out, consolidation, supply. So the most recent area of supply is right here, right? This essential area of consolidation. Now I can put my stop loss in a logical area. I don't have to put it down here. I also don't have to put it above this high. I could, but I don't have to put it above this high. I could go to a 15-minute time frame and just start playing around with the idea of where I should put my stop loss. I can go to a 5-minute time frame. And for me, it's more than reasonable to put it at this wick, because the logic is that if price is going to trade above these two bodies, it's going to trade above this wick with a very high probability. Again, I have data to prove this, right? In fact, I have hundreds and hundreds and hundreds and hundreds and hundreds of trades on this exact trading model to prove this. That would be my trade. If you look at it on the 5-minute time frame, you can also see a 5-minute bearish order block right here. Now, where would my target be? Well, I'm bearish. I'm just going to expect bearish continuation of price. So I'm expecting, probability indicates that this low down here is very likely to get taken out. So there's my entry level, there's my stop loss level, and there's my take profit level. And that is as simple as it is. That there becomes my trading setup. And you can see price comes back, tags us in, and immediately begins trading in our direction, which is honestly what you would like to see ideally. Have great levels of movement. And then again, when it comes to partials and when to go to break even and all that sort of stuff, I have rules exactly step by step for all of those things. For now, this is what you need. You're here for market structure. And that you can see the price plays out, the trade plays out beautifully. Now, I'll let you in on something. The reason that I'm able to show you this, even though this in of itself is what will make you profitable and can make you profitable, is without some other things, no matter how good of a technical analysis trader you are, you won't make money. Below this, I'm going to leave you a free training, 45-minute long, and I'm going to break down exactly what you need to do in order to become profitable and start making money from trading consistently.